Okay, so welcome to our webinar today. Like we do with every webinar, this webinar is being recorded, number one. And number two, obviously, I'll be sending out the PDF of the presentation as well as the recording, hopefully by late this afternoon. Any questions you have, just type it in the question box, like you did now with the sound check. But to get things started, I was going to ask Chris, what is the current situation with lot of investors with regards to ETFs? The way I look at it, I think many investors don't know the benefits of ETFs. They might not know how a property fund will fit into it. So, Chris, what is the what do you say? What do the current situation is with a lot of investors?
Yeah, I mean, fair enough, Sean. I think a lot of investors, and that's exactly why these webinars are so valuable, is we need to educate a lot of investors exactly what is an ETF, and why are they useful for investors, and how can they actually be used in your current portfolio scenario, be that as an online stockbroker type portfolio where you have shares already invested, or as a first-time investor who's looking to start something up, also in the online stockbroking environment, or as a monthly debit order or a lump sum investment. So, yeah, so I think education is very important, and we touch on what exactly is an ETF, and it's important to understand that because effectively it's just it's access to the markets, really. Okay. Is what it is. Yeah.
Cool. Well, Chris, I think I'm going to hand the presentation over to you. If I'll just do that and then just hide this away. And there we go. The people can still see us.
Brilliant.
There we go.
Thanks, Sean. Yeah, that's a good point to start on, and it's important to understand exactly what an ETF is, because otherwise it's just a strange acronym that you hear from time to time on the radio, or you see it in newspapers, etc. So, what is an ETF? So an ETF is just like any other share on the JSE.
What is the ETF? The acronym?
Yeah, I'll get to that. So okay. What it stands for is an exchange traded fund, and effectively what it does is the fund part is what we would typically understand as a fund, like a unit trust. And the ET part is that the fund is actually exchange traded. So in effect, if it's a fund which trades on the JSE just like any other share, like SAB or like British American Tobacco or any of the big shares that we know. So the big difference between buying a single share and buying an ETF is that when you buy an exchange traded fund, you get the fund part of the ETF. So what that means is you get access to a whole bunch of shares or a basket of shares which make up the fund effectively. So like today we're talking about property shares. When you're buying a property exchange traded fund, instead of just buying Growth Point and getting access to Growth Point, you buy one share, which is for instance, a PropTrax ETF, and you get access to a whole lot of underlying shares. And I guess really, what is the benefit of this? And the one immediate benefit, which I'm going to skip down to number 3 there, is diversification. So what an ETF or an exchange traded fund provides you with is immediate exposure to a basket or group of shares. And so it gives you instant diversification as opposed to buying one share. And this is especially useful for smaller investors who are looking to invest amounts where it maybe doesn't make sense from a cost perspective to try and buy 10 or 20 shares, where you can get access to those shares through one fund. So diversification is hugely important. The other thing is transparency. So even though you're buying into a fund, you know at any given stage exactly what is in that fund, whether that's property shares or equities or bonds. You know exactly what the holdings of that fund are. So even though you're buying a passive fund or a passive ETF, you're making an active decision about the underlying shares in that fund. It is not a passive decision to invest in the ETF. And the reason why you can make that decision is because of the transparency around these ETFs, so that you know all the holdings. An important thing to consider is the liquidity of these. So all of these are traded on the JSE just like any share, but the difference is that we as the ETF issuer are also a market maker. Now what that means is we effectively will buy and sell these shares to anyone at a fair price at any stage of the day, which at least you know that you're getting fair prices as an investor, which is quite important. Because, one of the anxieties that comes with investing is whether or not you're getting a fair deal. And that is certainly one thing that we as ETF issuers and core shares will promise to you as investors, is that we will give you the fair pricing. And if you don't think you're getting fair pricing, you're more than welcome to contact us. So we have an open door policy and are fully transparent around our pricing. I guess when we speak about flexibility of ETFs, we're speaking about flexibility relative to unit trusts, which, as you'll know, you can only make an investment once a day, and that's at 3 o'clock pricing traditionally. Whereas with ETFs, you can trade throughout the day at any stage of the day, so long as the market is open. And as I mentioned, we'll give you pricing throughout the day. Now, one of the most important things of these ETFs is they're cost effective. So they effectively offer you a cost-effective way to own a diversified market exposure or to own a diversified basket of shares. So what that means is, let's say, for example, the top 40. Now, you can either go and try as an individual to buy those shares, go out and buy 40 shares, but you will also incur 40 different brokerages with 40 minimum trades and 40 straight costs and so on and so forth. However, when you're buying an ETF, what happens is you buy one share to get access to that full basket. Now, the asset management company, or core shares in this instance, would go and buy those shares, but because we're an institutional company, we are able to buy those shares at much lower costs. And also, because we're bulking trades, we are able to get much better costing than you would as a retail investor. So that's the one cost component in terms of trading the shares and getting the exposure. The other cost component is the total expense ratios of ETFs tend to be much lower than the average active fund. So the general rule of thumb is that passive funds are about a third the cost of active funds. So if your average active equity fund is 1.5%, your average passive equity fund would be about 0.5%. Or even a lot lower. So that's a conservative estimation. In many cases, it's a lot lower. I mean, a lot of the passive equity funds are about 0.2% in terms of their total expense ratios. So really, that's a case for ETFs. And I think important to understand that ETFs are a vehicle or an instrument that gives you access to a whole basket of shares. And I think that's what Sean was touching on in the beginning. And it's important to understand that you're not taking on risk to us as core shares as the issuer. We actually go and buy those underlying shares and hold them in a portfolio on your behalf. So you're not taking on any credit risk when you're investing in ETFs. That's different to ETNs, but we're not talking about the notes of the exchange traded products world today. We're only chatting about ETFs. So Sean, I don't know if you want to add anything or.
Yeah, I think what's important to understand is there's, and Chris mentioned to it, there's two ways to have access to them. Number one is obviously from a normal trading account. It might be more cost effective if you've got existing portfolio of shares. Say, for example, you might be exposed to industrial shares and a lot more to resources and things like that, but you got no exposure to for example, listed property. Instead of like Chris said, now buying each individual fund in the listed property sector, through one share, you have access to a basket of stocks. And Chris will be talking about the income side of it, or the yield. I think that's a nice way of adding another dimension to a portfolio. So if you've got an existing share portfolio, one way to get involved in. The other one is to start what we call an investment plan. This is for someone just starting out, as Chris said, with either R1,000 lump sum or monthly, 300 Rand monthly debit order. And such time you build up the capital, and from there, obviously, you might want to start building your own portfolio. Over you, Chris.
Yeah, I mean, and just the one thing is that these all qualify for tax-free savings. So they, as an instrument, they all do qualify for tax-free savings, all ETFs. So I guess the point of today was not really to go into too much detail about ETFs. We have a broader understanding of how they work, and if you have any more questions, don't hesitate to put them on the forum. But we really wanted to chat a little bit about listed property and about the South African listed property market. So what I'm going to do is go through the general listed property market, and then have a look at what are the benefits of using listed property in a portfolio context, like Sean just mentioned. If you have equities and bonds, like how do you combine them into a portfolio? How do you combine listed property into a portfolio? And then having a look at two of the ETFs which we have in the market, to understand what are the opportunities that exist for you as an investor. So listed property effectively are companies which buy properties and hold them in a structure which is now called a REIT structure. Now, REIT stands for Real Estate Investment Trust. So these companies, and I'm going to use an example like Growthpoint, because everyone I think is familiar with a big company like Growthpoint, who is the biggest. They will buy shopping centers and office blocks and industrial properties, warehouses and distribution centers, and they hold them in a portfolio. That portfolio is then listed on the JSE, and by buying a share in Growthpoint, for example, you effectively get access to those, what we call real bricks and mortar investments. So you get access to the actual property investments through that particular share, like Growthpoint. So it is most certainly a tangible investment, which is like how we like to term it, secured by bricks and mortar, because there are actual underlying properties within those companies. Now, what is important is that under the REIT legislation is that these property companies are required to distribute their income. Now, that's where we get a starting yield of 5.07%. How that starting yield is, or income yield is constructed, effectively is from the rental income that the listed property companies gather in their underlying portfolio. So every month they will collect rent from their various properties, be it shopping centers or office parks or warehouses, and they gather that income and then distribute that income usually semi-annually. So that's how we get to a starting income yield of 5.07%, and that is the property sector in terms of what is called the SAPI index. So the property sector as ranked by size or by company size. The incredible tool of property in a portfolio context is not only the income, but it's the ability to grow that income. And generally, these property companies are able to grow their income at 6%. And you may ask how that is possible, but it's quite simply, as I'm sure you're all aware of, is the majority of the growth is made up from rental escalations. So within all rental agreements, there will be an escalation clause. There are other ways of achieving growth of income in terms of renegotiating leases and managing your properties more efficiently, and so on and so forth. But the lion's share of the growth really comes from your escalation or in-force escalations in a property portfolio. So it really is a powerful income tool when you're constructing a portfolio, because not only do you get the yield as you would in most other fixed income, but you also get growth in yield. So for this reason, it becomes a very powerful inflation hedge because of the growth component of the income, and because of that, it's a growth asset class. So really, listed property has been has had historically great performance relative to other asset classes. This is over a 10-year period up until the 29th of Feb 2016, and these are annualized returns. So this is through the financial crisis. It's through testing financial periods. And you can see the listed property index, which is that SAPI index I was chatting about, has performed very well relative to other asset classes, even the all-share, where you've got almost 3% annualized alpha by being in listed property, and then bonds and cash as well. So So really, property as an asset class is a powerful income tool in a portfolio, but you're not sacrificing growth like you are with a bond or a cash allocation, and really that's important. What's also important to note is that although property has performed exceptionally well in the past, this is certainly not an indicator of future returns. And we are in an uncertain, if I can put it that way, environment, especially because of the relationship between property and between the global yield environment. So in other words, the global interest rate environment and property have a high correlation, most notably in the short term. We can chat to that, and Sean, I think, has a few questions about the interest rate environment, which we'll get onto. But let's look at the asset class more holistically in terms of its use within a portfolio. So one of the most powerful tools we think are of property, along with its income component, is its diversification benefits when used in a portfolio. Now, when we're talking about, I'm going to skip forward a slide here if you don't mind. Mm-hmm. When we talk about using listed property in a portfolio context, we're talking about using it in the context of having stocks, bonds, cash, and property. So what we've done here is we've looked at historic data over 10 years up until the 29th of Feb, and we've looked at the risk and the return data. So not just looking at a return perspective, we're looking at the overall risk metrics. The first portfolio on your far left, you'll see has 0% property. It's got 60% stocks, 30% bonds, and 10% cash. So a classic conservative balanced portfolio. And you've got a Sharpe ratio of 0.39 with risk of 9.56% in terms of an annual standard deviation or an annual variance, and return of 10.8% in this portfolio. Now, what a Sharpe ratio measures is it measures the return per unit risk taken on a portfolio. So effectively what you're looking for is a highest as possible Sharpe ratio, because that means you're getting more return units per 1 unit of risk you're taking on. So then what we've done is we've kept the portfolio constant, but we've decreased our exposure by 5% in stocks and 5% in bonds, and kept cash constant. And what we have is we have a significantly higher annual return by 60 basis points a year, and we have a risk that's slightly lower. And that's really the beauty of including property within a balanced portfolio construct, because you not only get a return enhancement, but you get an additional benefit of lowering your risk. So you can see the Sharpe ratios increase quite significantly when we've included property in the portfolio. Now, important thing to note is that we didn't decrease the cash balance. Now, the reason why we haven't done that is because if we did decrease the cash balance, we would naturally outperform and we would naturally increase our Sharpe ratio. We've increased our allocation to risky stocks and bonds, because we are substituting it with a risky asset class. So we thought it was more fair to substitute the other risky assets as opposed to cash. Again, moving across to the right-hand side of your screen, we increase property to 20% and further decrease 5% in bonds and 5% in stocks. And again, we increase the return quite significantly to 11.99%. However, we've increased our risk as a function of having a higher component to property. Now, that's important to note that we have increased our risk by having a 20% property share in the portfolio. However, what the Sharpe ratio is telling us is that the increase in risk was worth taking on, because we're still getting more units of return per units of risk than scenario with 10% property, and certainly more than the scenario with 0% property. So depending on your risk appetite as an investor, you can tweak with your property exposure. But I think the overall important thing to note is that property has a place in a portfolio in terms of a holistic portfolio. And either way you look at it, it certainly improves the risk-adjusted returns of your portfolio. So these are the key considerations when you're using property in a portfolio, is that property is most certainly a growth asset class. And what it does do is it gives you the ability to outperform inflation plus targets over the long term. Now, importantly, over the long term, like any equity or high risk or growth asset class, you need to be invested in the long term. If you are a short-term speculator, there's the potential for serious capital drawdowns in your portfolio. So most certainly a long-term allocation. But as important as we know it is, it has the ability to outperform inflation and therefore protect the capital value of our portfolio over the long term. So it has, as we showed earlier, not only does it have the ability to outperform from a return perspective, but the diversification benefits when held in a balanced portfolio decrease the risk of your overall portfolio. The third point there speaks about rand hedge diversification benefits, which I think is becoming more and more topical and is very important. And we'll touch on that more when we dive into some of the detail of the product, where we'll show you the exact rand hedge components. And here, this last point, which we maybe can chat a bit more about, Sean, if you want to ask questions.
Yeah.
Although there's short to medium term uncertainty in the property, and we would define short to medium as probably between a year to 3 years. There's uncertainty in property. However, I must say that there's uncertainty in all asset classes, equities and cash, local and domestic, or at least global and domestic. But the fundamentals of property, which essentially is the rental income that properties companies provide, and the growth, which is effectively escalations and management efficiencies, are really what drive long-term performance of this asset class. So long-term, I'm talking 3 to 5 upwards years, more towards 10 years. So really, although you may have concerns in the short term, you can be assured that you're going to get 5% income, and that income is going to grow at around 6 to 8%. So you're looking at a conservative return profile in the long term of somewhere between 12 and 14%. And that's really, you can back solve properties return profile by looking at the fundamentals, as opposed to the short-term price risks, which are more driven by global sentiment.
Okay.
Yeah, yeah.
I think one of the questions or one of the considerations a lot of people have when it comes to listed property would be what's the effect of rising interest rates on the listed property market. And I think that's one of the risks, and maybe we can elaborate on.
Yeah. So exactly, the rising interest rate environment is a key driver in terms of the short and medium term property returns. Most notably the capital returns. And at a very basic level, how it works is we have a global yield environment that's driven by global yields. So like the American government bonds, the European government bonds, the British government bonds, yen, so on and so forth globally. And that has an impact all the way down onto our long bond, which is the R186, the South African government bond. Now, in terms of the global bond environment, if the Fed, which is the American bonds, decides to increase rates and bond yields start rising globally, then there's a knock-on effect across all bond yields. So Euro bonds will rise in terms of their yield, so will UK bonds, and equally so will the R186, which is the South African bonds. Now, what that means, because the South African bond yield rises, is because property is effectively a yield tool and is in the short term driven by the yield environment, the property yields will also rise in line with that. What that means for you as an investor is your capital is going to decrease in the short term. So because they are perpetual instruments, in other words, because they're not listing more bonds every week and they're coming to market with a new bond, because they're perpetual instruments, the way that the yield will adjust to rise is by the capital dropping. Now, that has a catch-22 because if you're invested in the instrument at that time, your price of your instrument drops off, but it also gives other investors or you opportunity to buy the same instrument at a higher yield. So that most certainly has an impact, and that's why we've highlighted here short to medium term uncertainty because of the global yield environment. Now, no one really knows where global yields are going. What we do know is that they probably aren't going down from here. So you've most likely, and the Fed came out 2 weeks ago and said that they're most likely to only raise rates twice this year, where they were planning on doing 4, which means we've got a slower increasing yield environment. Now what that means for property is that there's less risk to capital based on that assumption that interest rates are going to move upward slowly. However, there certainly is risk to property in an upward moving interest rate environment in the short to medium term. What disconnects property in the long term is the growth component. So bonds and other yield asset classes like cash allocations, they don't have a growth component to their income. They generally have a fixed or floating income stream, but they certainly don't have a growth component. And that's why property in the long term tends to be quite disconnected from the bond market. If we scroll back up and we look at the returns of the property market and the bond market, over the last 10 years, you've got 7.22% from the bond market and 16.11% from the property market. And sure, property may be mispriced. It may be slightly expensive at the moment. However, what you can see, the differential is effectively the growth component in the property market. So through the cycle, what you do get out of property, and that's where its inflation beating nature comes from, is the growth component. So long-term, property can be quite disconnected from the bond market and from the interest rate environment because of the growth component. Now, the growth component, I mean, we could argue the fundamentals of this all day, but that sits at the company's ability to enforce escalations and their ability to manage their properties more efficiently. Now, if there's poor economic growth, the property company's ability to push escalations through becomes less. So property is, in many respects, a fair barometer of the economic environment. However, the general sentiment is that property companies are still able to push through escalations. So the growth component of 6%, which I touched on, is quite conservative given the current environment. In fact, over the last year or two, most property companies have been able to grow their income at north of 10%. Okay, so really that's listed property within a portfolio construct and at an asset class level. I guess the question is, why would you invest passively in property? I think Sean wanted to touch on this, as opposed to being an active stock picker. Or alternatively investing in an active fund, which are available. Now, we see Growthpoint as now a huge listed company on the JSE, and the listed property market has certainly grown enormously over the last 10 years. But the total market cap still sits at around 425 billion rand, which, if you consider that relative to the rest of the market, is still very small. Where it's smaller than Richemont's market cap, the whole property sector. Sure. So we have to understand it in the context of the whole market. And because of this small and concentrated market, with Growthpoint making up about 19% of the total market, Redefine close to 15%, and Nepi 12%, there in those three stocks you've got about 45%. It becomes very difficult for large asset managers to outperform the index. And you may ask yourself why, if there's such an obvious bias towards these companies. And the answer is quite simple. It's liquidity. If you have a fund that is bigger than, let's say, 2 billion rand, which most of the active funds are, there are some who are smaller, but a lot of them are, then they will really struggle to buy shares outside of the index because they simply cannot. They don't have the liquidity to do so. And if they did buy the smaller companies, let's say they managed to buy 10 million rand of Delta, which is a smaller company, it becomes such a small component of their fund that they almost are, the return advantage is negligible. So I guess this begs the question, does the sector allow active management? Well, yes, it does, because there's certainly the ability to outperform the two indexes that I'll show you. But what you have to be careful for if you're an investor is investing in an active strategy, which is effectively a closet passive strategy. And the problem, or what we call closet passive managers, the problem with that is not the asset manager's skill. It's they don't have the ability to invest any other way, and you start paying active fees for a passive strategy. And that's really where the problem is. If you find an active manager with a small, nimble portfolio, sure, he and high conviction stock picking, he'll probably have the ability to outperform the index. And you as individual investors may have the ability, but you must remember when you're selecting one or two stocks, you're taking on significant stock-specific risk. Okay. So that's looking at passive and why you would use passive in the context. Okay. So yeah, so let's have a look at two of the portfolios which are available through Core Shares. The first is the PropTrack SAPI. PropTrack SAPI is the traditional market cap weighted property index. Now, what that means is that effectively when we're allocating weightings in the portfolio, we allocate according to the size of the portfolio. So in this instance, the biggest property companies get the biggest weightings. So Growthpoint gets 19%, as I mentioned. Redefine's the next biggest, gets about 14, 15%. NEPI, 12%, so on and so forth, all the way into the tail. And there are 20 shares that make up this total portfolio. Now, if we have a look at all the constituents in the fund, they're all the regular property components. But what's important to note in this fund when you're investing, and when you're investing more generally in any passive fund, is you really have to understand what is in the portfolio. So you're not just investing in the property market here, you're making a big bet on Growthpoint, on Redefine, on NEPI here. Those four shares, those three shares make up about 45% of the portfolio. So you really have to understand what's in your portfolio before you make an investment into it. However, having said that, it is a reasonably well diversified portfolio with 20 shares, but again, it's important to highlight the concentration in those top holdings, where the top 7 shares make up around 70% of the fund. So I touched on earlier. So let me go back one step. Apologies. If you look over here, the yield is around 5%, and as I mentioned, that will grow somewhere between 6 and 8%. So again, a yield tool in your portfolio. The return has been great, but as you can see, varied. And in the last year, it's been quite poor. In fact, close to very marginally negative returns over the last year. That's as a function of that interest rate environment you're talking about. Now, what's important to note? Yes, certainly, and perhaps the buying opportunities have unfortunately passed, because when the Fed came out to say that the interest rates would remain lower for longer, property has since rallied quite significantly. Because now the market has confidence that the yield environment is fairly stable and that we have perhaps a slower upward rate environment, the property markets have rallied. So that's swung quite significantly in the last couple of months, because these are up until the end of, I believe this is as at February, apologies. So in the last month, you'll see a swing into positive territory. I think it's about the 1 year returns about positive 5%. Okay. Now. So quite significant swings. So that's what we were chatting about, the short-term environment. But certainly opportunities to buy the yield, because remember, that's the key consideration when you're investing in property, is when you buy it, you're locking in an effective yield on that day. So if the yield is attractive to you, regardless of the short-term sentiment, it should be a component in your portfolio. Now, this is quite an interesting slide, because most people don't consider this when they're investing in the South African property market. It's that the South African SAPI or the market cap exposure actually is about 35% of offshore exposure. Now, this is in some instances, and in fact all instances, is direct offshore exposure. So all of the first 4 shares you see, MSP, which is Mass Real Estate, NEPI, Rockcastle, Stenprop, and Tradehold, they're all direct physical real estate holdings offshore, with 100% of their portfolio offshore. So by buying this, you're getting access effectively to the UK property market, to the Romanian property market in terms of NEPI, the Polish and the European and the American property market in terms of Rockcastle, and then some African exposure and European exposure in terms of Stenprop and Tradehold. And then you'll see it gets lower in some of the exposures as you move towards the tail. And what that is some of the bigger property portfolio companies like Growthpoint have significant exposures offshore now. They've been building their own offshore portfolio. So Growthpoint has significant Australian exposure, and Resilient has significant exposures in some of the other listed property companies that have offshore exposure. Okay. So by buying this basket, you're not getting a South Africa only story. You're getting a significant offshore exposure of around 35%. Mm-hmm. And as I mentioned, it is in almost all instances complete direct offshore exposure. So physical properties you effectively own offshore in big jurisdictions. So that's the PropTrack SAPI. Sean, I don't know if you want to raise anything from your side.
I might be.
Yeah, so this is what when you hear about the property market on the radio, or the property market is up 2% or down 5% for month to date, this is what you're hearing about. This is exposure to that market. It's the top 40 equivalent for property. Mm. What we as a company picked up is that within the PropTrack SAPI and within that market cap exposure, there's a concentration risk to a few shares. So what we constructed was what we call the PropTrack 10, and it's effectively a top 10 equally weighted portfolio. So we take the shares which are top 10 as ranked in their size in that previous index, and we reweight them according to an equal weighting methodology. So effectively, each share gets 10%.
Yeah.
So what we do is those three shares which had 45% now only have 30%. And we think it's a fair concentration spread across the portfolio. The one impact of that in terms of the yield is you have a slightly lower yield of 4.8%. Now, the reason for that is TAC, if I scroll onto this slide, has a 10% holding in the core shares PropTrack 10, and it only has around a 3% holding in the SAPI. Now, TAC is not a REIT like I described earlier. TAC is actually a development company, so they are not obliged to distribute their rental income. Okay. They, in fact, reinvested and developed new properties. So for that reason, it drags the whole yield of that portfolio down. However, what a tax management team would certainly argue is that their growth component is going to be higher than a company that distributes all of their income, or 75% of it at least. So that's the reason why the yield is lower. Now, if you look, this slide just shows you the reallocation of capital across the portfolio. So effectively, what this portfolio does is it downweights Growthpoint from 19% to about 10. It downweights Redefine. It downweights NEPI, and then the rest of the property companies there from 3 till 10. So the next 7 effectively get upweighted in the PropTrack 10 index. So it's really to avoid concentration risks in a given portfolio. So I guess the question is, well, how do you choose now? How do you choose which one to invest in? If you, as an investor, like the property sector but are not too clued up about it, you want to allocate to it, you don't like Growthpoint, you have done your research on Growthpoint, and you can really research 2 companies here and make a call. You don't like Growthpoint, you don't like Redefine, you find that big mature companies, the ability to grow is more difficult than the others, then you would allocate to PropTrack 10. If you like Growthpoint because they're the most established and they're the largest player, you would then perhaps buy the PropTrack SAPI. So it really comes down to investor preference. We think that in the top 10, all of the property companies are fair, are credible and large players and liquid enough to trade. So we think that by reducing concentration risk and allocating equally over the top 10 makes a lot of sense, even though it's at a slightly lower yield. If you're an investor who is hungry for yield, then maybe the SAPI makes more sense for you. And I don't mean to confuse the debate by having 2 products, but
sure.
But those are the sort of considerations that you have to think about when you're investing. If I can scroll back to see the differences in the return between the 2. Now, what's important to note is the 2 indexes. The dark blue column is the SAPI index. Now, the SAPI index, if you remember, is the size-weighted index, the market cap with the big exposure to Growthpoint. The maroon color is the 10 index, And then the blue color is the actual fund, the ETF. So that's real return numbers which you can bank on. Now, you can see slightly different return dynamics between the two portfolios. And this is played out as a function of a few things. The one thing is that historically, and now this has changed in the SAPI index, but historically the PropTrax 10 index, because it had holdings in NEPI and Rockcastle at 10%, it had a much higher offshore exposure than the SAPI index. That is normalized now, and their offshore exposure is very similar, and that's as a function of those companies becoming so much bigger in the SAPI index, right? But previously, because we upweighted them, we gave them more exposure, I guess unnaturally. So the performance over 2 years and 3 years has been quite significantly higher than the SAPI index. Over the long term, it's been about 2% per year better. So there's a factor of the rand hedge exposure which has come through in those bottom shares, which is now sort of normalized, and I'll show you why that's normalized. There's also something which we call in the indexing world called a size factor. Now, a size factor effectively says, and it's something that's been researched empirically over the long term, is that if you invest in smaller companies, you will get outperformance over the long term. So smaller companies tend to outperform bigger companies. So this has a bias towards the smaller companies, and perhaps that's why it's outperformed. So really, those are the products. This is the last slide on the offshore exposure, which again looks very similar. Which looks very similar to the SAPI, again at 35%. So going forward, we're not sure whether that will be as much a driver of returns. If another offshore company gets included in here and takes out SAC, for example, then the offshore component may ramp up significantly. But for now, they're very similar in terms of their offshore components. So really, that's all from me. And if you have questions, please post them. And thanks to Sean for your time and to everyone for tuning in. Here we go.
Okay, some questions here. Let's tackle them quickly. Does PSG offer all ETFs, and how do we trade them on your platform? It's a question from Tony. Yes, we offer all of them, Tony, on our platform, on the equity platform, as well as the investment plan platform. Another question here from Tony. How do I find a list of ETFs only? At this point in time, there's not available on the website, but Tony, I'll drop you an email with that list, okay? Let's see if there's any other questions coming through. I appreciate your questions, Tony. Thank you. Pleasure, Tony. Okay, looks like those are all the questions. Okay, I was just thinking, as I say, from my side, the ideal situation for an investor with regards to ETFs, especially property, would be to have, if you're a long-term investor, to have exposure to property. We saw that advantage of rand hedge. We saw the advantage of inflation beating returns and things like that. So it's something to consider. Okay, great. I think that's looks like all questions coming through. So from my side, oh yeah, another question from Tony. What are the share codes for the two ETFs?
So the PropTrax SAPI, which is the size weighted, is PTX SPY. If you maybe want to type that in there, I don't know if you can. And the PropTrax 10, which is the equal weighted, is PTX 10 TEN.
Sorry, you don't.
Should I type it in?
Yeah.
There we go. Enter.
Yeah. Just enter and
I'll put in the other one there.
Yeah.
Oh, caps is on.
Yeah. Click in the box. Yeah. Select the question.
Oh yeah.
Yeah. And then type again another code. Here we go.
There we go. And PTX 10.
Yeah, I see it all. There we go. Great. I think that's questions from Waldo. Okay, so why not use equities as an asset class outperforms property over all periods?
Waldo, I think you may have misread there. Over the last 10 years, property has outperformed equities. However, let's couch this discussion less about performing of one asset class of equities and property. Effectively, both property and equity are growth asset classes, which is important to know. So we would certainly expect both property and equity to outperform bonds and cash and inflation over the long term. Now, you should have a healthy mix of both property and equity. Equity tends to be deeper and more diversified basket of shares with exposure to different industries. So that is in many instances why equity is a larger component of a portfolio, because quite simply there's the liquidity, and whereas property is slightly more concentrated and almost what we'd call an alternative asset class, although it's becoming more and more mainstream. So I don't think it's about using property at the expense of equities or about using equities at the expense of property. I think it's about trying to blend both of them into your portfolio construct along with cash and bonds to develop a sensible portfolio to help achieve your long-term objectives, which in most instances would to be outstrip inflation plus type targets, inflation plus 5 or 7. Yeah.
But Greg, thanks for your question, Waldo.
Thank you.
There's a question here from Steros. What about the tax implications?
Sure. So tax on property, it's not a dividend in terms of the distributions. The majority of property will be taxed as income if you're an individual. So you need to consider the after-tax effects, and you need to consider that there is a tax implication. Capital gains is identical, but also remember at an after-tax level, you're still getting most likely a higher yield from property than equities. Yeah.
Okay, great. Thanks for the question, Stelos. There's a question from Quivers. Where can I find the income distribution percentage of the ETFs on PSG share trading platform? Quivers, I'll have to come back to you on that one. I'm not 100% sure, but I'll come back to you on that one. I see there's a dividend yield as well. So I presume total income equals dividend yield plus rental income.
Yeah, that's right. There can be a dividend component, like in Attack, for example, which is a development company. And all the other REITs do have the ability to distribute dividends, but they're generally a much smaller component of the income. So the lion's share, really 90% of the income will come from rental income, which is effectively taxed as income or interest.
Income distribution.
Yeah.
And a question from Waldo again. What is your view on the increasing interest rate cycle? How does this affect listed property? Will you advise is this a safer bet? Waldo, we did touch on it, but I think maybe just...
Yeah, sure. I'll just highlight that again. So view on the interest rate cycle. I mean, this is our house view, so it's not... we unfortunately don't have crystal ball ability to predict it. Most likely, interest rates will be lower for longer, especially given the Fed's direction on the last couple of weeks. But certainly not a decreasing interest rate environment globally. We probably think that interest rates will move up slowly in the medium term. And as we mentioned, there is risk to capital in property when interest rates move up. Property does prefer interest rates to move up slowly, so more predictably, which is what seems to be playing out.
Sure.
When there's sharp movements in interest rates, you get sharp capital re-rates in the property market. So we don't think you're at risk of sharp capital re-rates. And that can be, remember, that can be on the downside and the upside, because we've had upside re-rating in property market in the last month, as I mentioned, because people expect rates to be low for longer. But remembering that's in the short to medium term. If you're constructing a portfolio for the long term, you should consider the long-term drivers of property return, which is that income and that growth. So over 5 to 10 year period, you would expect property to deliver pretty much their income and their growth in income. So if the SAPI starts at 5% and grows at 6 to 8%, you can expect 12 to 14%, and so on and so forth. So again, it's a short versus a long term.
Okay. Here's a question from Quivers. What would be the impact on property in relation to other asset classes should South Africa credit rating be downgraded to junk status?
Yeah. So good question, Quivers. if the credit rating is downgraded to junk status,
discount is already, I think, to a large extent.
Yeah, Sean was just saying the discount is already built into the pricing of a lot of our assets, and I would agree with that. We probably would see a reaction across the market. That is going to impact all asset classes, because every asset class comes off the basis of valuing the share based on cash flows, and that's discounted at an interest rate which is driven by our long-term government yield, and that is what's going to be impacted the most by the by the change in the credit rating or by downgrade. Now, property in the short term will react, because I think what will happen most likely is our government bonds yields will spike, so property yields will most likely spike in the short term, and then what you'll have is capital. So there's definitely risk to the downside. That's why we've tried to highlight as much as possible that there's short to medium term uncertainty, not only in property, but in bonds and equities alike. Sure. So it will definitely have a negative impact on the property market, and you will probably see a capital movement which is greater than equities, because the income component is a greater component of the return relative to equities, where growth is a greater component of return in the equity spaces. So I would expect capital to drop by more than what equities do. But as I said, I think if there's a downgrade, the whole market will be, you're not safe.
Great, thanks, Chris. I think we're running out of time, people. Chris, just to tie up all the strings, in conclusion, what would you say is the most important thing for our people on this webinar to walk away with today? What's the most important takeaway?
Yeah. I think what's important is that property as an asset class has been ignored to the detriment by a lot of South African investors. You can see it's still quite a small market, but I think it should form part of your portfolio. I'm certainly not proposing it is 50% of your portfolio, but to have an allocation to property over the long term, I think is definitely a good idea.
Great. Okay, guys. So what's next? As I said, I'll be sending out this presentation to you guys. If you haven't got property in your portfolio, maybe consider the two ETFs we spoke about today from Core Shares. That's number one. And any questions you guys have, welcome to drop us an email from the recording I'll send you a bit later. And I think it's I hope you guys liked the format today. We're first busy talking and bantering away here with questions. Thanks, Tony. It's also nice to see that we're on the webcam so you can see us. So, guys, from our side, thanks very much. Next week, we got a webinar. We're going to discuss offshore investing. And obviously, the opportunities where we see investments offshore. We'll be discussing that. The week after that, we'll be discussing the pros and cons of investing and trading. So that's a bit more for those of investors and traders. And then the week after that, we'll be talking more about, call it unit trusts, investing in unit trusts and the pros and cons there. And then end of April, we'll be discussing how endowment policies can help you as an investor, especially those of you that have high tax rates. Okay. But from our side, I'd like to say thank you very much to Chris and to Gladys from Core Shares for coming through. It was a bit longer than we expected. But thanks a lot, and I hope you guys also enjoyed it. All the best, and until next time, keep well. Bye for now.